Welcome to Talk Tickers. We're your direct line into earnings calls, cutting through the jargon to get to what really matters.
We pull out the key insights, the strategies, the things that actually make a difference.
And today we're diving into Vitesse Energy's Q2 2025 call. And let me just say, the market definitely sat up and took notice with this one.
Oh, absolutely. Vitesse really delivered, a comprehensive beat across pretty much every key metric. You saw that reflected in the market reaction. Definitely positive.
It felt like more than just good numbers, maybe hinting at something deeper operationally.
Exactly. It hints at, strong execution and maybe some smart strategic moves paying off.
Okay, let's get into those headline financials because honestly, they're quite impressive. Q2 2025 GAAP EPS hits $0.60.
Yeah, and just think, the consensus estimates, they were sitting around, what, $0.30, so 42 cents?
So yeah, not just a beat, that's like almost doubling expectations right there.
Exactly. And the revenue story is just as strong. $81.8 million.
Comfortably ahead of the $57 to $71.5 million the street was looking for. That's a solid 23% jump year over year.
And what really grabs you, I think, is the production side. That's the engine, right?
Right.
They absolutely surged, hit 18,950 barrels of oil equivalent per day. Bode good oil mix too, 65%.
And put that in context, that's up 27% just from Q1.
27% quarter over quarter, and get this, 40% year over year, a 40% jump.
Wow. That shows some serious acceleration in their operations.
It really does. And the other numbers line up too. Adjusted EBITDA, $61.1 million.
GAAP net income, $24.7 million. And importantly, free cash flow, actual cash, $21.9 million.
A healthy free cash flow, and crucial for investors, they held that quarterly dividend steady at 0.5625 per share.
Which works out to $2.25 per share annually. So when you see all these numbers hitting like this, what's your immediate takeaway?
For me, it streams a company that's really firing on all cylinders, strong fundamentals. And the market's positive reaction, that share price jump, it reflects what I'd call maybe constructively bullish sentiment.
Constructively bullish. I like that.
Yeah, it's not just the beat itself, it's how they beat. Strong operations, that unexpected cash boost, solid dividend support, and importantly, a really disciplined approach to growth.
So it kind of de-risks the outlook a bit.
Significantly de-risks it, I'd argue. Yeah, this wasn't just one lucky break.
Okay, great summary. So let's dig into those drivers. What really powered these results? What were the key things behind those big numbers?
Well, a huge piece, you can't ignore it, was a one-time $24 million cash payment came from a legal settlement.
Ah, okay. So just a one-off cash injection.
Well, yes and no. Yes, it boosted revenue, offset some old litigation costs, but, and this is maybe more important long-term, the settlement also set up new long-term gas deals.
Gas deals. Gathering, processing.
Exactly. Gathering, processing, marketing agreements. And these new deals are expected to really improve the value they actually get for their gas. Management thinks it could mean an extra $2.5 to $3 million annualized just for the first half of the year. And the key is they'll be taking their gas in kind.
In kind. Can you quickly break that down? Why is taking gas in kind a big deal here?
Sure. So instead of just getting a check from, say, a pipeline company based on some index price, in kind means Vitesse gets the actual physical gas.
Okay.
Which means they control how it's marketed, where it goes, who they sell it to. They can optimize pricing, maybe find better markets. It gives them much more control over that revenue stream.
So it moves them up the value chain a bit, potentially captures more margin.
Precisely. And it reduces their reliance on third-party pricing.
Yeah.
It's a smart strategic move for long-term value and risk reduction. You don't always see that kind of detail in the headlines.
Oh, you don't? That's a great insight. Okay, let's switch gears slightly. The Lucero acquisition, that closed back in March, right? How's that integration going? Did it deliver as promised?
Yeah, closed March 7th. And by all accounts, the Lucero integration has been, well, another real success story, maybe even better than expected in some ways.
Better.
Management was pretty clear. Assets are performing right on track, which is good. But the kicker is they're seeing better G&A synergies, general and administrative cost savings than they originally planned for when they bought it.
Ah, so they're running it more efficiently than they first thought they could.
Exactly. More cost savings than baked into the deal model. And that efficiency directly helped boost that Q2 production number we talked about.
So it wasn't just buying assets, it was integrating them really effectively.
Right. Seamless and actually adding value beyond just the production volumes.
Okay, this is where it gets interesting for me. Capital discipline.
Yeah.
Everyone talks about it. But how is Vitesse actually doing it, especially with potential M&A deals floating around?
They seem very focused here. They talk about a returns-driven hierarchy for capital, meaning they look at the return first, they're selective. It's not about spending a fixed budget just because it's there.
Yeah.
And you saw that in Q2. Capex was $35.6 million, almost all organic stuff, drilling and completions. And crucially, they funded it entirely from their operating cash flow.
So no new debt needed for capex.
None. In fact, they used the cash flow to pay down their revolver debt. Got it down to just $106 million.
Wow. And what does that do to their leverage ratio?
It brings their net debt to adjusted annualized EBITDA down to just 0.4 times, 0.4.
That is incredibly low for this sector.
It's exceptional. Anything under 1x is great. 0.4x gives them massive flexibility, a really strong balance sheet.
Okay, but you mentioned M&A. CEO Bob Giddy apparently said there's robust deal flow, especially for bigger, chunkier assets. How do they square that potential opportunity with this discipline? Isn't there a risk of, getting tempted?
That's always the tension, isn't it? And yes, Giddy apparently said it's the most deal flow they've seen in this bigger asset category in like 12 years. So the opportunities are there.
Right.
But, and it's a big but, they were adamant about sticking to strict return hurdles. Any deal has to support or grow the dividend, be accretive, and critically, not drag down the performance of their existing assets.
So they're window shopping, but they're very picky shoppers.
Exactly. Disciplined hunters, not just accumulating for size. They won't chase growth if it hurts shareholder value. That was the clear message.
Good message to send. Now, commodity prices, always volatile. Oil, gas. How are they protecting themselves, especially that dividend, which is obviously key for them?
Yeah, protecting the dividend seems paramount, and they do it through a pretty extensive hedging program. It's quite strategic.
How much are they hedging?
For the rest of 2025, about 71% of their expected oil production is hedged. The weighted average price is around $69.83 a barrel. That puts a solid floor under a big chunk of their oil revenue.
Okay, that's oil. What about natural gas? Prices there have been all over the place.
For gas, almost half of their remaining 2025 production is hedged too, but they're using collars mostly.
Collars, meaning a floor and a ceiling.
Right. Gives them downside protection, but lets them participate in some upside. The weighted average floor is attractive, $3.73 per MMBTU, and the ceiling is up at $5.85. So a pretty good range.
And are these just short-term hedges?
No, and that's key. They've extended hedges well out. Natural gas hedging goes into Q1 2027, and they even have NGL hedges out into 2026.
Wow, locking in cash flow visibility way out into the future.
Exactly. That gives them and investors a lot of confidence in the sustainability of that dividend. It's a strong foundation.
Very clear commitment there. So, okay, strong Q2, solid hedging. What's the outlook for the rest of 25? Did they raise guidance after such a blowout quarter?
Interestingly, no. They actually just reaffirmed their existing full year 2025 guidance.
Reaffirmed, even after that big beat.
Yep. Production still guided between 15,000 and 17,000. BODI'd, oil mix 64-68%. Cash capex range $80 million to $110 million, mostly weighted to the first half, which is already done.
So why not raise it? Seems conservative.
But here's the interesting part. Management added some color commentary. They basically said the chance of hitting the low end of that production guidance is pretty minimal.
Pretty minimal.
Unless oil prices completely crater and operators suddenly stop drilling. That was the caveat.
So reading between the lines.
Reading between the lines, it sounds like classic under-promise, over-deliver territory. They're likely feeling confident, but setting a bar they feel very comfortable clearing.
Which leaves room for future beats or maybe a guidance raise later.
Exactly. It's smart investor relations. Build credibility, create potential for positive surprises down the road, suggests quiet confidence.
Okay, that makes sense. Let's touch on costs quickly. Any trends in LOE or G&A we should know about?
Sure. Lease operating expense, LOE, was $11.38 per BOE. That was up a bit from Q1.
Why the increase?
They linked it directly to the Lucero integration initial operational tweaks, optimizations. But, those efforts probably helped drive that higher Q2 production, so maybe think of it as an investment that paid off immediately in volume.
Fair enough. What about G&A, the overhead costs?
G&A looks promising. Once you adjust for that legal cost reimbursement from the settlement, the underlying run rate is somewhere in the mid $3 per BOE.
Mid $3, is that good?
It's pretty efficient. And importantly, management expects that G&A per BOE number to keep declining as production grows.
Operating leverage.
Exactly. Their existing corporate structure can handle more barrels without G&A costs rising proportionally. That's very good for profitability as they scale.
Okay, so let's pull all these threads together. What does this Q2 mean in the bigger picture for investors, especially those experienced in the energy space?
I think it reinforces that constructively bullish sentiment we talked about, especially for disciplined non-operators like Vitesse.
Right.
Driven by that strong operational momentum, the strategic value of that settlement, not just the cash, but the de-risking aspect, the solid dividend, and that disciplined M&A stance.
So the story they're telling is,
The story is a non-operator building a durable dividend-paying platform, using smart deals, good contracts, now strengthened by cash and scale. And the goal seems to be compounding modest growth through really disciplined capital use.
and how does this fit with what's happening in the wider industry, particularly in the Bakken where they operate?
Well, one key trend benefiting them is the constant improvement in capital efficiency in the Bakken.
Meaning operators are getting better at drilling.
Getting much better. They're using longer laterals. We're talking 3-mile, even 4-mile horizontal wells now. And they're doing more refrac.
Refracking older wells.
Exactly. Stimulating existing wells again to get more oil and gas out, extending their life. It makes the whole basin more productive for every dollar spent.
And how does that help Vitesse specifically, since they're non-operators?
Because they get a piece of those better, more efficient wells without having to pioneer the technology or bear the full operational risk themselves, they benefit directly from their partner's innovation.
Riding the wave of efficiency improvements makes sense.
Yeah, it's a real tailwind for their model.
Now, what about industry consolidation? There's been talk about Chevron potentially taking over Hess's Bakken assets. That's a huge player entering the scene. Good or bad for Vitesse?
Management sounded, I'd say, cautiously optimistic about that.
Cautiously optimistic.
Yeah, they pointed to what happened when Chevron went into the DJ Basin. Chevron's presence actually led to more activity, more drilling.
So they think Chevron coming into the Bakken might stimulate more activity there too.
That seems to be the hope, or at least the speculation. More activity by a major like Chevron could mean more drilling opportunities that Vitesse can participate in.
So potentially another catalyst for their non-operated portfolio.
Potentially, yes. A positive spillover from that big consolidation move. It's something to watch.
Okay, so summing up the investor view, what are the key things listeners should keep an eye on for Vitesse in the next few quarters? The main catalysts.
Right. Key catalysts. First, just keep executing, hitting or beating that reaffirmed guidance, especially given the commentary around the low end.
Okay.
Hedging. Any updates there? Locks in more cash flow certainty. Third, watch for that back-end consolidation impact as activity pick up, especially if Chevron takes over Hess's assets.
And fourth,
M&A, can they actually find and execute on those bigger, chunkier deals that meet their strict return rules? A truly accretive acquisition would be a big positive signal.
execution, hedging, consolidation impact, and accretive M&A.
Got it. Those are the core things that will likely drive the story from here.
All right, now for the part of the show that always sparks some debate internally, our not financial advice segment, we pitch a wild, maybe but plausible trade idea based on our dive. What have you got for the committee this time?
Okay, committee, listen up. Based on Vitesse's Q2, the strong underlying trends, and that, let's call it understated confidence from management, I'm pitching a calendar spread option strategy on Vitesse Energy.
A calendar spread. Okay, explain the thinking there. Why that strategy?
The rationale is this. Q2 was great. Guidance was reaffirmed, but seems conservative. Management hinted they'll likely beat the low end easily. So, the market might not have fully priced in that positive momentum continuing through the second half. There might be more upside coming than is obvious right now.
So you're betting on sustained positive news or maybe a guidance raise.
Exactly. Betting on that understated confidence translating into actual results that surprise the market again, or at least lead to a guidance bump.
And mechanically, how does a calendar spread capture that?
Okay, so you'd buy a longer dated call option, maybe 6 months out, slightly out of the money. At the same time, you sell a shorter dated call option, maybe 1 or 2 months out, at the same strike price.
Buy long-term, sell short-term, same strike. Got it.
Right. The idea is if Vitesse keeps performing well or raises guidance, the value of that longer dated option you bought should increase due to both price movement and potentially higher implied volatility faster than the shorter dated option you sold loses value from time decay.
So you profit from the difference in how those two options behave over time, assuming the stock moves favorably or volatility increases.
Precisely. You're essentially betting that the market will gradually recognize the company's strength over the medium term, causing that longer dated option to outperform the drag from the short dated one. It's a play on that compounding growth narrative, betting management's quiet confidence is justified.
A sophisticated play on that underlying narrative. Definitely gives our listeners something to chew on. So, to wrap things up, Vitesse Energy really knocked it out of the park in Q2. Strong production, big financial beats, smart moves with the settlement and the Lucero integration.
Absolutely. You've got disciplined capital use, strong hedging, commitment to the dividend, all playing out in an improving Bakken environment. It really does position them well, not just for one quarter, but potentially for sustained shareholder returns.
And just to be crystal clear, this has been Talk Tickers, but this is absolutely not financial advice. We strongly encourage you, always, to do your own thorough research and due diligence before making any investment decisions. Your capital is your responsibility.
Couldn't agree more. Do your homework.
We'd love to hear your thoughts. Find us on social media. Thanks for tuning in to Talk Tickers.